Hello everyone and welcome to Compliance Lookup. This is Ayush. We will discuss two very important topics: anti-money laundering and know your customer. These concepts play a crucial role in preventing illegal activities such as money laundering and fraud, ensuring the safety and integrity of financial systems worldwide. Whether you're someone working in the finance industry, a student, or just someone interested in learning about how businesses protect themselves from financial crimes, this video is for you. These topics are essential for financial security, and in future videos, we'll dive deeper into how these procedures are implemented, the tools used, and the real world impact they have on businesses and individuals. If you found this video helpful, don't forget to like, share, and subscribe for more content on financial compliance, regulations, and more. I divided the topic into two parts. Part 1, I will cover AML, and Part 2, I will cover Know Your Customer. These are all the topics we cover in future. Our first chapter, money laundering and terrorism financing. Money laundering is the process of disguising money that comes from illegal activities so that it looks like it comes from legal sources. In simpler terms, it's a way for criminals to clean their dirty money earned from illegal operations like drug trafficking, arms dealing, or extortion so they can use it in the legal economy without raising suspicion. Criminals typically make money from illegal activities. Let's imagine someone running an underground business smuggling goods. They can't just go to a bank and deposit millions of dollars from illegal sales. If they do, the bank would ask questions and law enforcement could get involved. This is where money laundering comes in. It hides the true source of the money and makes it look like it was legally earned. Placement: this is the first step, where the criminal introduces the illegal money into the financial system. For example, a drug dealer might take cash from drug sales and deposit it in a bank or buy assets like cars, real estate, or jewelry. Let's say a criminal runs a nightclub. They can mix the illegal money with the profits from the club's legal operations to hide the origin of the money. Layering: in this phase, the launderer tries to hide the money's illegal origins by moving it around through multiple transactions. For example, they might transfer the money between different bank accounts in different countries, buy and sell assets, or make complex financial deals. The goal here is to make the money trail so confusing that law enforcement cannot trace it back to the crime. Imagine someone buying expensive art in one country and selling it in another, moving the money between different currencies to further obscure the trail. Integration: this is the final step, where the now clean money re enters the economy as legitimate funds. At this stage, the money can be used to buy houses, invest in businesses, or make other legal purchases without raising suspicion. The criminal can now live a luxurious life, owning fancy cars, properties, or businesses, all with what appears to be legitimate income. For example, after all the layering, a person could use the laundered money to open a chain of restaurants or invest in real estate without anyone questioning where the initial capital came from. One famous example of money laundering is Al Capone, the notorious American gangster. He ran several illegal operations like bootlegging alcohol during Prohibition in the 1920s. Capone would use laundromats to disguise his illegal profits, hence the term money laundering. He would mix his illegal money with the legal earnings from the laundromats, making it harder for authorities to figure out how much money came from crime. Another modern example is HSBC Bank. In 2012, it was discovered that HSBC had failed to stop Mexican drug cartels from laundering over $881 million through their bank accounts. The money came from drug trafficking, and the cartel used a complex system of transfers and shell companies to obscure the source of the funds. HSBC was fined heavily for not properly monitoring these transactions. The concept of money laundering has been around for centuries. In ancient times, merchants would hide money from tax collectors by moving it through multiple transactions or disguising the source. But modern money laundering became more common with the rise of organized crime in the 20th century. Criminal networks like drug cartels use these methods to hide billions of dollars in illegal profits. Today, with global financial systems and digital banking, money laundering has become even more sophisticated. Criminals use offshore accounts, shell companies, which is companies that only exist on paper, and even cryptocurrency to launder money and avoid detection. Money laundering. The process of hiding the illegal origin of funds has profound effects that go well beyond criminal networks. It creates a ripple effect that can hurt economies, destabilize societies, and even threaten governments. Let's dive into these impacts. Erosion of trust. When people realize that the financial system is being used to launder dirty money, they begin to lose trust in banks, governments, and the economy as a whole. Imagine if you found out that your local bank is secretly helping criminals clean their money, would you feel safe keeping your savings there? Economic instability. Money laundering leads to financial bubbles and market distortions. For example, in countries where real estate is used to launder money, housing prices can skyrocket, making it unaffordable for regular citizens. This was seen in cities like London, where luxury apartments became a favorite tool for laundering money, driving up property prices. Funding of illegal activities. Laundered money is often used to finance terrorism, human trafficking, and drug cartels. The money that has been cleaned goes back into the hands of criminals, fueling more crimes and violence. The infamous Panama Papers scandal revealed how offshore companies were being used to launder money, fund terrorist activities, and hide corruption. Tax evasion. Criminals involved in money laundering don't pay taxes on their illegal earnings. This results in huge losses for governments, reducing the amount of money available for public services like healthcare, education, and infrastructure. For example, it is estimated that $1 trillion is lost globally each year due to tax evasion facilitated by money laundering. Corruption. Money laundering often involves bribing public officials and authorities to look the other way. This kind of corruption destabilizes the political system and erodes the rule of law. In countries like Venezuela, laundered money has been linked to widespread corruption, causing political unrest. Reduced tax revenue. When criminals launder money, they avoid paying taxes, resulting in lower revenue for governments. Countries that rely heavily on tax revenue to fund social programs and infrastructure suffer. For example, the Greek financial crisis was partly worsened by tax evasion and money laundering practices, which drained the economy. Distorted markets. Money laundering distorts markets by making it difficult for legitimate businesses to compete. For instance, a company involved in money might offer prices below market value because their goal is to clean the money, not make profits. This undermines fair competition and can push honest businesses out of the market. Financial instability. Large scale money laundering can lead to instability in financial markets. Banks unknowingly involved in laundering may face liquidity crises or be subject to huge fines, as in the case of HSBC, which was fined $1.9 billion for facilitating money laundering by Mexican drug cartels. Reduce foreign investment. Countries known for rampant money laundering face reduced foreign direct investment (FDI). Investors don't want to put their money in unstable, corrupt environments. For example, countries like Nigeria have struggled to attract FDI due to concerns over corruption and money laundering. Increased crime. Laundering money allows criminals to keep funding their operations, leading to an increase in organized crime, drug trafficking, and human trafficking. More crime means more violence, insecurity, and fear in societies. In countries like Mexico, the vast sums of money laundered by drug cartels have fueled drug related violated violence. Inequality. Money laundering contributes to income inequality. as it allows a small group of criminals to accumulate vast amounts of wealth at the expense of the general population. In countries like South Africa, money laundering linked to state capture has widened the gap between the rich and the poor, depriving the country of essential services and resources. Erosion of social values: when crime becomes a common way to get rich, it can change society's values. In regions where money laundering is widespread, people may come to believe that crime pays, undermining respect for hard work and ethical behavior. Corruption: money laundering often leads to widespread corruption in governments and law enforcement. Officials may accept bribes to turn a blind eye to illegal activities. In countries like Russia, money laundering has been linked to oligarchs and government officials, damaging public trust in political institutions. Political instability: money laundering can destabilize governments by funding terrorist groups or criminal organizations that seek to overthrow legitimate regimes. In conflict zones like Afghanistan, for example, money laundering has been used to finance terrorism, undermining the government's ability to maintain control. Terrorism financing: money laundering is closely linked to terrorism financing. Terrorist groups use laundered money to buy weapons, train recruits, and finance attacks. This poses a direct threat to global security, as seen in regions affected by groups like ISIS and Al Qaeda. While it's hard to pinpoint exactly how much money is laundered globally, it is estimated that the figure could be as high as $2 trillion annually. That's about 2 to 5% of the global GDP. The clandestine nature of the activity makes it difficult to measure, but it is a massive global issue that requires international cooperation to tackle. Now we will come to impact on financial system. Vulnerability of the financial system? How? What happens if these safeguards are weak? Real world example: HSBC money laundering scandal. Customers began to lose trust in the bank's ability to protect their money. Investors started questioning the integrity of the bank's management. Public perception shifted, associating the bank with crime and corruption. Regulatory action. Types of penalties. Hefty fines: banks may be fined millions or even billions of dollars for non compliance. Restrictions: regulatory authorities might restrict the bank's ability to operate in certain areas or provide specific services. Suspension of operations: in extreme cases, the bank's operations could be temporarily or permanently suspended. Real world example: Deutsche Bank fine. The bank faced regulatory penalties. It suffered reputational damage as people associated it with a high profile criminal case. Now we will discuss about Financial Action Task Force FATF. The FATF is like the global watchdog for financial crimes. It was created in 1989 to help countries combat money laundering, terrorism financing, and other financial crimes that threaten the stability of the world's financial system. Think of it as an international organization that creates the rules for how countries should protect their financial systems. Role of the FATF: FATF develops what we call the 40 recommendations. These are like a rule book that countries must follow to make sure their banks and financial institutions have strong systems in PSE to prevent financial crimes. These rules include customer due diligence: CDD banks need to know exactly who their customers are. This is part of Know Your Customer by verifying their identity and assessing the risks they may pose. Reporting suspicious activities: financial institutions are required to report any suspicious transactions that might be linked to money laundering or terrorism financing. Monitoring financial transactions: banks must monitor transactions to detect unusual patterns that could signal illegal activities. Real world example: FATF gray and blacklists. FATF also holds countries accountable. They regularly publish gray lists and blacklists. Grey-list countries on this list don't fully comply with FATF standards but are working on improving their systems. Blacklist countries on this list are considered very high risk for money laundering or terrorism financing because they don't follow FATF's recommendations at all. For instance, North Korea and Iran have been on FATF's blacklist for not complying with global financial crime standards. Being on these lists has serious consequences. Other countries are less likely to do business with them, and their access to the global financial system becomes restricted. 1.4.2 Egmont Group of Financial Intelligence Units FIAS. The Egmont Group is like a global club of financial intelligence units FIAS. FIAS are specialized government agencies that collect, analyze, and share financial information to help fight financial crimes like money laundering and terrorism financing. Role of FIAS. Each country has its own FIO. These units gather data on suspicious transactions happening in their country and share it with law enforcement agencies to catch criminals. The Egmont Group makes it easier for these FIAs to cooperate with each other even across borders, which is critical because financial crimes are often international. Real world example FinCEN US FIO. Take FinCEN as an example. The Financial Crimes Enforcement Network is the FIO for the United States. Imagine a case where money is being laundered through several countries. FinCEN can work with FIAs from other countries in the Egmont Group, sharing financial intelligence to trace the money trail. For instance, if FinCEN detects that suspicious money is being sent from the US to a bank in another country, they can contact the FIO in that country, share the data securely, and work together to track down the criminals. Next is the Wolfsburg Group. The Wolfsburg Group is a unique collaboration between 13 of the world's largest banks. These banks came together to set standards and develop best practices for managing financial crime risks, especially focusing on AML, anti-money laundering, and KYC practices. Think of it as a group that helps banks figure out how to protect themselves from financial crimes. Role of the Wolfsburg Group. The Wolfsburg Group issues principles and guidelines to help banks understand what they should do to properly identify and verify their customers' KYC, manage risks related to certain types of banking, like private banking and correspondent banking, when one bank provides services to another, monitor and manage relationships with other banks to avoid being used for illegal activities. Real world example Wolfsburg AML principles. One of the key documents produced by the Wolfsburg Group is the Wolfsburg AML Principles, which provide detailed guidance to banks on how to manage the risk of being involved in money laundering. For example, in private banking, where wealthy clients are moving large sums of money, the Wolfsburg Group provides banks with recommendations on how to carefully screen these clients and monitor their transactions. The guidelines help banks ensure they are not unwittingly helping to move illegal funds. In summary, the FATF sets the global standards for fighting money laundering and terrorism financing. Its 40 recommendations guide countries on how to strengthen their financial systems. Countries that don't comply with FATF's rules can end up on the grey or black list, which affects their global financial relations. Egmont Group. This is a network of FIAS financial intelligence units from different countries. FIAs collect and analyze suspicious financial activities and share information with law enforcement agencies and other countries to combat international financial crime. Wolfsburg Group. This is a group of global banks that creates guidelines for financial institutions to follow when dealing with high-risk clients, banking relationships, and transactions, especially related to AML and processes. Each of these organizations plays a key role in ensuring that the global financial system is safe, transparent, and resistant to misuse by criminals. Now let's discuss United Nations Office on Drugs and Crime UNODC. The UNODC is a United Nations agency that deals with global issues related to drug trafficking, organized crime, and terrorism. Since money laundering is often linked to these illegal activities, the UNODC plays a critical role in combating it. Role of UNODC. The UNODC helps countries improve their anti-money laundering AML frameworks by providing technical assistance. They help countries build stronger systems to detect and prevent money laundering. This includes offering expert advice on setting up financial intelligence units FIUS, implementing know your customer rules, and improving regulatory measures. Promoting international cooperation. Since money laundering often involves multiple countries, UNODC helps different nations work together to tackle this problem. Supporting the implementation of one's ML conventions. These are global agreements that countries sign to commit to fighting money laundering. Real world example UNODC's Global Program Against Money Laundering GPML. Through the Global Program Against Money Laundering GPML, the UNODC helps countries set up effective systems to detect and combat money laundering. For example, if a developing country lacks the proper tools to monitor suspicious transactions, the GPML might help them build a better financial crime detection system, train their law enforcement officers, and establish fires to track illegal money movements. International Monetary Fund (IMF). The IMF is an international organization that focuses on global economic stability. It helps countries manage their economies and ensures that their financial systems are strong and secure. When it comes to AML and KYC, the IMF has a key role in assessing how well countries are following international standards and providing them with the support they need to improve. Role of the IMF. The IMF monitors how well its member countries are complying with AML and KYC standards. It checks whether countries have effective systems in place to prevent financial crimes like money laundering and terrorism financing. It also provides technical support to help countries improve their regulatory and enforcement mechanisms. For example, the IMF may offer advice on how to strengthen laws and policies to make it harder for criminals to exploit the financial system. Real world example IMF supporting a country's central bank. Imagine a country's central bank is struggling to prevent money laundering because its regulations are outdated. The IMF might step in to provide advice on how to update the bank's KYC policies to ensure that customers are properly verified and suspicious transactions are flagged. This advice could include implementing more stringent customer due diligence processes or enhancing the monitoring of large transactions. World Bank. The World Bank works closely with the IMF and FATF to help countries, especially developing economies, build strong systems to fight money laundering and terrorism financing. The World Bank focuses on improving financial systems in countries that may not have the resources or expertise to implement effective AML and KYC regimes on their own. Role of the World Bank. The World Bank offers technical assistance and capacity building services. This means they help countries strengthen their regulatory frameworks, the laws and rules that govern financial systems, and train law enforcement officers so they can better detect and stop financial crimes. The World Bank also provides financial support to help countries implement these systems. In countries where resources are limited, the World Bank's funding can make a big difference. Real world example World Bank helping developing countries. In some countries with weak financial systems, it can be hard to track illegal money flows or properly identify customers. The World Bank may step in and provide funding and expertise to improve customer due diligence processes. For example, they might help a country's banks implement better KYC procedures, ensuring they comply with international standards and making it harder for criminals to open fake accounts or move illicit money. In summary, the UNODC helps countries build stronger anti-money laundering systems, promotes international cooperation, and provides technical support through programs like the Global Program Against Money Laundering (GPML). The IMF assesses how well countries are complying with ML Know Your Customer standards and provides technical assistance to improve their financial systems, like advising central banks on better regulations. The World Bank helps developing countries build effective AML know your customer regimes by providing financial support, technical assistance, and training to law enforcement. These organizations work together to strengthen the global fight against money laundering, making the world's financial system safer and more resilient to criminal activities. Now let's discuss Basel Committee on Banking Supervision. The BCBS is a global organization formed by central banks and regulatory authorities from different countries. Its main job is to set international standards for banks to follow. This includes making sure that banks have strong systems in place to prevent money laundering and terrorism financing through proper AML anti-money laundering and know your customer regulations. The role of the BCBS. The BCBS focuses on sound risk management and ensuring that banks comply with international standards. It provides guidance to banks on how they can create strong customer identification procedures, part of Know Your Customer, and transaction monitoring systems to detect suspicious activities. These standards ensure that banks around the world are operating under the same rules when it comes to identifying customers, managing risks, and detecting potential financial crimes. Real world example Basel AML Index. One important tool developed with the help of BCBS is the Basel AML Index. This index ranks countries based on their risk of money laundering and terrorism financing. It provides an easy way for governments and financial institutions to assess where the risks are highest and which countries need to strengthen their AML KYC measures. For instance, if a country ranks poorly on the Basel AML index, it means that it's more vulnerable to money laundering activities. Financial institutions from other countries might be more cautious when doing business with that country because of the high risks involved. How BCBS fits into the bigger picture. The BCBS works alongside other global organizations like the FATF, IMF, and World Bank to create a strong global framework for fighting money laundering and terrorism financing. Their focus on setting banking standards ensures that financial institutions around the world follow stringent rules, which helps protect the overall integrity of the financial system. For example, if a bank in one country isn't following BCBS guidelines on KYC or transaction monitoring, it may become an easy target for criminals who want to launder money. By enforcing these global standards, BCBS ensures that banks across all countries operate in a safe, transparent, and compliant manner. Hence, the summary is BCBS, the Basel Committee on Banking Supervision, sets global standards for banks, especially around risk management, customer identification, and transaction monitoring to prevent money laundering and terrorism financing. Basel AML Index, this index developed with BCBS, helps rank countries based on the risk of financial crimes, giving financial institutions insight into where the greatest threats lie. Together with other organizations, BCBS helps ensure that the global financial system is well protected against financial crimes, creating a safer banking environment for everyone. Now let's discuss money laundering and its impact on banks. Money laundering is a serious global issue and it can have devastating effects on the banking system. Now let's look at some real world examples of how banks have been involved in money laundering and the consequences they faced. 1. Bank of Credit and Commerce International BCCI. First, we have the case of BCCI. This was one of the largest scandals in banking history. BCCI was a global bank operating in 78 countries. But behind the scenes, it was being used to launder money for criminals, drug cartels, and even terrorist organizations. The bank was essentially a hub for illegal activities which went unnoticed for years because of its complex structure and international reach. However, in 1991, the truth came out. BCCI was shut down after losing over $10 billion. This scandal not only caused financial losses for customers, but it also damaged the reputation of governments and regulators who failed to detect the crimes early on. Key takeaway: if banks don't implement proper controls, they can become platforms for laundering massive amounts of illegal money, as seen with BCCI. 2. European Union Bank of Antigua. Next, let's talk about the European Union Bank of Antigua. This was an offshore bank set up in the Caribbean, which sounds legitimate, right? However, it was actually involved in large scale money laundering, especially targeting investors from Europe and North America. The bank took advantage of loose regulations in offshore banking to move illegal funds. Eventually, the authorities caught up and the bank was shut down. Unfortunately, by then, many investors had already lost significant amounts of money. Key takeaway: offshore banks like the European Union Bank of Antigua can be a major risk if they aren't properly regulated, often serving as vehicles for illegal financial activities. 3. Riggs Bank USA Pinochet case. Now, let's turn to a case closer to home in the USA involving Riggs Bank. Riggs Bank was once a very well respected bank in Washington, D.C. However, it became infamous for its role in laundering money for Augusto Pinochet, the dictator of Chile. The bank helped Pinochet hide millions of dollars in secret accounts while he was under investigation for human rights abuses and corruption. When this was discovered, it led to a huge scandal and the bank was fined $16 million. Key takeaway: even highly respected banks can face reputational ruin if they are found to be involved in money laundering, especially when it involves politically exposed persons, PEPs, like dictators or corrupt leaders. 4. Riggs Bank user Teodoro Obiang Nguema Embezogu Equatorial. Riggs Bank wasn't done. It was also implicated in another scandal involving Teodoro Obiang Nguema Embezogu, the president of Equatorial Guinea. The bank allowed Embezogu to launder millions of dollars through secret accounts, hiding state funds meant for his country's people. These funds were derived from oil revenues, and rather than using them for the development of the country, they were funneled into private accounts. This scandal added to Riggs Bank's troubles and eventually led to the bank being sold to another institution. Key takeaway: involvement with corrupt politicians and allowing them to launder public funds can lead to the complete collapse of a bank's reputation and even its existence. Now let's discuss terrorism financing. Terrorism financing is a process by which terrorist organizations collect money to fund their activities. This money enables them to carry out attacks, recruit new members, purchase weapons, and sustain their operations. What makes terrorism financing particularly dangerous is that the money often comes from a mix of illegal sources and sometimes from legitimate avenues that are misused. 1. Illegal activities. A significant portion of terrorist funds comes from illegal activities. These activities can range from: black money means money earned through illegal means and not reported for tax purposes. Drug trafficking means selling drugs like heroin, cocaine, or opium to generate cash. Arms smuggling means buying and selling weapons illegally to make a profit. Example, the Taliban and the opium trade. Let's take the example of the Taliban in Afghanistan. Afghanistan is one of the largest producers of opium in the world, which is used to make heroin. For many years, the Taliban has controlled large parts of the opium production and used this trade to fund their activities. The illegal opium trade has brought in millions of dollars annually, allowing them to buy weapons, recruit fighters, and carry out terrorist attacks. So, in this case, terrorism financing is happening through the illegal drug trade, which not only harms people through drug addiction but also fuels violence and terror. 2. Misusing charities and NGOs. Another method terrorist groups use is by misusing legal systems like charities or non mental organizations NGOs. On the surface, these look like legitimate charitable organizations that collect donations to help the poor or provide humanitarian aid. However, the money collected is secretly sent to terrorist groups. Example, fake charities. A specific example would be organizations like the Islamic Relief Fund, a fake charity. This charity claimed to be raising money for humanitarian causes, but in reality, the funds were diverted to support terrorist activities. This is a tactic used by many groups, where they play on people's emotions to collect donations, but behind the scenes, they are sending the money to fund terrorism. This is why it's so important for governments and financial institutions to have strict AML anti-money laundering and CTF counter-terrorism financing measures in place to verify whether the money is being used for its stated purpose. 3. Hawala network. Now let's discuss the Hawala network. This is an informal, unregulated system used to transfer money and it's widely used in South Asia, the Middle East, and Africa. The problem with Hawala is that it operates outside of the formal banking system, meaning there are no records, no paper trails, and no oversight by regulators. How Hawala works. Let's say someone in India wants to send money to a person in Pakistan. Instead of going through a bank, they go to a Hawala broker. The broker takes the money in India and tells their counterpart in Pakistan to give the same amount to the recipient. No actual money crosses borders, but the transaction is still complete. Because it's fast, cheap, and doesn't leave a trail, terrorist organizations use this system to move funds across borders. Example, Hawala and terrorism financing in India. There have been many cases where money was transferred from India to Pakistan based terrorist organizations using the Hawala network. This system allows terrorists to send money for operations without worrying about being detected by authorities, as there's no formal record of the transaction. Cryptocurrency in terrorism financing. Cryptocurrencies like Bitcoin are increasingly being used by terrorists to finance their operations. These digital currencies have become popular because they allow for anonymous transactions and are difficult to trace. This makes it easier for terrorist organizations to move money across borders without being detected by traditional banking systems. Example, ISIS and Bitcoin donations. For instance, ISIS, the Islamic State, used Bitcoin donations as a way to fund their operations, including propaganda and recruitment. The group encouraged their supporters to donate money in Bitcoin to support their cause. Since Bitcoin transactions are decentralized and do not require a traditional bank or financial institution, they are hard to track, which makes them an attractive tool for terrorists. 5. Ransom and extortion. Another method used by terrorist groups to fund their activities is through ransom and extortion. Terror groups might kidnap people, especially high profile individuals, and demand a ransom in exchange for their release. Similarly, they might extort money from businesses or governments in exchange for not carrying out attacks. Example, Somali pirates and terror financing. One of the most famous examples is the case of Somali pirates. These pirates often hijack ships and kidnap crew members, demanding large sums of money for their release. The ransom money was then used to fund terrorist activities in Somalia and other regions. This form of extortion has been a major source of financing for terror groups operating in the Horn of Africa. Impact of terrorism financing. Terrorism financing has several severe consequences, both locally and globally. Here are the key impacts. 1. Global security threat. When terrorist groups are able to fund their operations, it directly fuels violence and terrorism, putting global peace at risk. These funds allow terrorists to carry out attacks, spread propaganda, and recruit new members, which can destabilize entire regions and even countries. 2. Economic loss. Terrorist attacks can cause significant economic damage. Beyond the immediate loss of lives and infrastructure, these attacks disrupt industries, tourism, and trade, leading to long term financial losses. For example, the 9/11 attacks in the US caused a ripple effect that led to global economic downturns and substantial losses in the stock markets. 3. Loss of trust in financial systems. When financial systems are used to fund terrorism, it erodes public trust in these systems. People begin to lose confidence in the banking sector, believing that their money may be misused. This can lead to people withdrawing their funds from financial institutions or engaging in illegal activities like money laundering to avoid being part of a compromised system. How to combat terrorism financing? Combating terrorism financing requires a coordinated effort across multiple sectors. Here are some key strategies to prevent and detect such financing. 1. AML Anti-Money Laundering and KYC Know Your Customer regulations. Banks and financial institutions have a key role in monitoring suspicious transactions. By implementing AML and KYC regulations, banks can detect and report any transactions that seem out of the ordinary, such as large unexplained deposits or donations from unverified sources. These regulations are designed to ensure that the money flowing through financial systems is legitimate. 2. International cooperation. Organizations like the Financial Action Task Force FATF set global standards for combating terrorism financing. FATF encourages countries to work together by sharing information and enforcing similar regulations to prevent terrorist groups from accessing financial resources. The FATF regularly monitors and blacklists countries that fail to comply with these standards. 3. Tighter monitoring of cryptocurrencies and informal systems. As cryptocurrencies like Bitcoin have become more widely used, it's essential for governments to implement tighter controls and monitor cryptocurrency transactions to ensure they are not being used for terrorism financing. Similarly, informal money transfer systems like Hawala must also be regulated to prevent misuse by terrorists to transfer funds across borders without oversight. I hope you understand whatever things I taught in this video. My next chapter is on money laundering some methods. Thank you for watching.